What's going on, champs? So today we're going to talk about leverage and brokers. Like I mentioned in a past video, brokers are the middleman. Having a broker is what allows you to trade in the financial markets. This is where you place your money, sort of like a bank account, where you put your money and then you attach it to a trading platform which allows you to take trades. What I'm going to talk to you about is regulated versus unregulated. The only difference is one has licenses. Regulated brokers have licenses that allow them to operate legally in these countries. This means you can have full confidence that you can actually trade in your country. Something to look out for when you're looking for brokers is what type of licenses that they have and where are they regulated. The top tier regulators are actually the hardest places to get a license from. And these include the USA, which is the SEC and FINRA, the UK, which is the FCA, Canada, which is CIRO, and Australia, which is ASIC, also known as ASIC. Obviously, it's your choice on what broker you want to use, if it's regulated or unregulated. Talk about leverage. The easiest example I can give you if you're a beginner is the stock market. Stock market has a one-to-one leverage, meaning whatever you buy is how much you own. So for example, if a Tesla stock was $700, the only way you would get that is if you spent $700. Sure, there's a thing called fractional shares, but they still don't allow you to own one share of the stock. You have to spend what you own. However, in Forex, we tend to see much higher leverage. This means you have more buying power with your money. A common example that we see is 1 to 200. This means for every dollar that you have in your account, you have 200 times that power. So that means every dollar you have gives you $200 of buying power. Going back to the stock market example, every dollar you spend just means you spent a dollar. While in Forex, every dollar would equal $200. If that makes sense to you, just understand using high leverage like that is at your own risk. Obviously, with that, the more you can win means the more you can lose. A good leverage to start at is 1 to 200, but depending on your broker, you could see things like 1 to 500 or even higher. You're going to learn something in our future videos called lot size. The higher the leverage means the higher the lot size you can actually have in your account. So what we call all this is leverage or margin trading. Remember the video where I went over the pip calculation in gold? You remember that the price was almost $3,000. If you only have a $200 trading account, how could you possibly buy a unit of gold? Leverage is how you can do that. Understanding leverage and brokers is extremely important when starting your live account, because this is most likely how you're going to be making your income from your trading journey. So now you know, and we're going to move on to the next video, which is how to actually enter a trade or a signal in your phone.